one of the participants for real.
Well, great. I hope they enjoyed it as well.
Oh, yes, yes. So I can't wait for what you have to share with us today. And this just shows you how fast the time has gone because it doesn't seem like it's been 2 weeks since we had the last one, right?
No, and it doesn't seem like it's already March, 3 months
Right.
into the year.
Right, absolutely. Look, this is the what? 3 months into the year, we're winding down the first quarter. This
Yeah,
is where, we've got to start looking at how we're trending and tracking to our goals. Because clearly, while, we may be able to have some off times in the first quarter, we definitely need to use the first quarter as a barometer as to what we need to adjust or track going forward. Because I'm telling you,
exactly.
after that second quarter, it's like all downhill.
It is,
Right.
and as you said, first quarter estimated taxes are due on April 15th, the same day that your regular taxes are due. So you have two things that you're battling. So yeah, this is the perfect time for this particular workshop.
Yeah, I'm excited about it. So, look, I've got my pen and paper, and I am just hoping today that I have none. So good. I'm glad you're on. We're recording. If my computer decides that it wants to act up again, uh, we know that you will capture it all.
Yes.
Yeah, so that worked perfect. Oh my gosh. So, but I'm excited. Let's see who we have here. I'm just going to look in the chat. We have Rosa. Okay. And of course, we have you, Desiree. And so, Rosa, welcome. She's joining in. We're glad. She's all the way from San Jose, California. So it is 11 a.m. there in California.
Hi, Rosa. She was the first one to say good morning from San Jose, California.
Yes.
I see Dina. I can't see. I'm telling you, I'm getting old. Let me just put my glasses on and stop playing around. Dina, I can't pronounce her last name. I don't want to mess it up. Is it Messersmith? You got Amy Robinson, Carolina, Giselle, Kai, Leanne, Megan, Melanie, Mia, and of course, Rosa. Hi, guys.
Yes,
Oh,
they're coming
aloha from Hawaii. Okay.
Oh, wow.
Yes.
Is Kai who's from
Kai.
Kai is
Yeah.
from Hawaii? Guys, yes, I'm telling you, you're missing a treat. This is going to be so awesome. I mean, yeah, I am glad that we decided to do this as a three-part series because this was so much information. And one of the things that I really hate doing is when you attend a class that basically whets the palate. It gives you enough information that gets you thinking, but not gives you enough information to really execute well. And so that's what I really appreciate what you're doing in this series for us. So it is definitely well received and appreciated. So are you about ready to get started, Desiree? I think we're going to go ahead and jump in.
Yeah, I'm ready.
Okay, all righty, guys. Well, we're going to get started today. And for those of you who are joining us live now, and for those who will be catching this on the replay, welcome. I am your host, Carla Jones of Salon Solutions Group. And together, Desiree and I have teamed up and partnered to provide to you, the beauty and barber industry professional, information and critical information that really helps you guide your business in relation to taxes. And I tell you, we often use the phrase that knowledge is power, but when it comes to taxes and things this serious about our business, I think not only knowledge is power, but how to apply the knowledge that we learn correctly for our particular business structure is even more critical. And so on today, Desiree, who is our facilitator and our guest presenter, also the owner of Anderson Accounting, LLC, Desiree will be presenting today, and she's going to go into detail as I turn it over to her. So welcome, Desiree Anderson. She's going to be presenting today's session, which is part 2 of our 3-part session. So we've got one more after this. And so today is all about what you need to know for estimating your 2019 taxes and other information she's put together that is pertinent. So Desiree, with that being said, I'm going to go ahead and turn it over to you and you can just take it away. Welcome.
Okay, hi everyone. I'd like to first start out by thanking you for taking a time off on a Monday, which is usually a day off for most stylists. And I appreciate the fact that you decided to join us today in the middle of the day. I really do appreciate that. As Carla said, my name is Desiree Anderson, and I am a former hairstylist and salon owner. So I was a hairstylist, salon owner. I was an educator for Farouk Systems. For those of you that remember BioSilk back in the day, and Farouk Systems, we were the, I didn't say we, but Farouk Systems was one of the first people to come out with the ionic iron back then. When they were charging $100 for an iron, prior to that, we were all using the iron. I forget the name, but it was $10. So it was a bit of a jump to go from paying $10 to paying $100 for an iron, but they innovated that whole ionic thing. So I was glad to be a part of that back in the day. And in addition to being a former hairstylist, salon owner, platform artist, I owned a salon, as I said. I am now a certified public accountant. So when I decided to become a CPA, I said, well, what industry should I specialize in? And it was a no-brainer for me because I know the beauty industry inside and out because I was part of the industry. So for me, it was an easy decision to decide to niche into this particular industry. Now, one of the reasons why I decided to, other than the fact that I know the industry very well and I feel your pain, I know your pain, I've been where you are. In addition to that, I remember when I was in cosmetology school, as those of you on this broadcast know, we didn't learn anything when it came to business other than how to make sure that we are, performing our shop duties properly and on time. We learned nothing about business. So it's my mission to try to bridge that gap between what we did not learn in beauty school and what we should know as business owners. So that's my mission. So most of the things that I put out, most of the content that I put out, it actually surrounds trying to help beauty industry professionals just understand the business side of business from an accounting and from a tax perspective. Now, I know this is not exciting. I know it's not as exciting as going to a class and watching somebody cut and color and do all those fancy, fun stuff. I know that, but it is needed. So in order for you to enjoy the fun side of our business, you really do have to understand the business side. That way you stay in business, okay? And because I deal with a lot of stylists in my business, I see the things that happen, the things that go wrong, some of the things that cause them to actually have to, shut their businesses down. Now, one of the major things that I notice when it comes to working with, and not only just hairstylists, but just independent contractors as a whole, because in addition to being an accountant and also dealing with taxes and accounting, I also represent taxpayers before the IRS. So what that means is if you're having an IRS issue, whether you owe the IRS money and you're trying to negotiate some type of deal with them, or if you're under IRS audit, you would call a person like myself to come help you. Now, one of the things that I noticed is that a lot of independent contractors, booth renters, salon owners, mobile stylists wind up owing the IRS year after year after year. And what happens is once you owe them, let's say for the first year you become an independent contractor, it compounds. So you owe them in this year, the next year, the year after that, and it becomes like an albatross around your neck, because when you don't settle a debt with the IRS and you're going from month to month, or rather from year to year owing them money, you can start out owing them $2,000. And by the time it's all said and done, 10 years later, you owe them like sometimes $50,000, $60,000. And I've seen that, okay? And one of the main reasons why most independent contractors, most business owners wind up owing the IRS is because they do not pay their estimated taxes. Because it is a lot easier to pay the IRS, let's say $1,000 a month, than it is to come up with $12,000 at the end of the year. So this class is going to help you understand what you need to do to calculate your estimated taxes and also just the requirements for paying, who is required to pay, who is not required to pay, and so on and so forth. So I'm going to go ahead and share my screen with you so we could get started. Let's see. Let's go back to the beginning. There we go. Slideshow. Okay, can you, oh, wait a minute. I'm sharing the wrong screen. So let me drag this over here. Okay. I was hoping this wasn't going to happen, but okay. So bear with me, guys. Okay, let me try this again. Okay, so can you see my screen? Okay, Carla, can you come back on and let me know if you can see my screen?
Yes, we can see it.
Okay, good. Okay, so this is a 3-part workshop, as Carla said, and today's topic is calculating and paying estimated taxes. So what are we going to be talking about? We are going to be talking about who is required to pay estimated taxes, okay? Actually calculating your estimated taxes. So in other words, what are the different ways that you can actually calculate your estimated taxes in 2019 so you can pay them on a quarterly basis? We're going to talk about when those estimated taxes are due, because they all do have a due date, how to set aside monthly payments. Now that's really important because even though you're paying the taxes on a quarterly basis, which is every 3 months, or in some cases every 2 months, or in other words, well, I'll let you know how that works, because even though it is quarterly, you don't tend to always pay it every quarter, even though it is called quarterly estimated taxes. So we're going to talk about that and how that works. And then how to set aside money on a monthly basis is really important, because even though you're paying it on a quarterly basis, you don't want to wait to the end of the quarter to actually come up with the money. What you want to do is every month when you do your bookkeeping, you put money aside for the quarterly taxes so that you have the money at the end of the quarter to actually make the payments. So once again, you don't want to start, trying to figure out how to come up with $6,000 at the end of the quarter when you could have saved $2,000, each month. And then we're going to talk about the different ways that to pay your estimated taxes, because there are a few ways that you can pay them, about 2 or 3 different ways that you can actually make these payments. And then we're also going to talk about how to account for your state taxes. Now, keeping in mind that this particular webinar or workshop is only covering federal taxes, okay? But even though, in addition to paying your federal taxes, you're also required by law to pay state taxes. That's if your state has taxes, because not all states have income tax. For example, I think Texas and also Florida, they don't have a state income tax. So if you're in those states that don't have a state income tax, you don't have to worry about paying estimated taxes. However, if you are in a state that has, income tax, then you also want to put aside money for your state taxes. Okay, let's see. All right, so we're going to first start out with who is required to pay estimated taxes. So if you're a sole proprietor, and a sole proprietor will mean that you're an independent contractor, or you're in a gig economy. So gig economy basically are people who, like Uber, for example, if you drive for Uber, if you drive for Lyft, and even if you are a hairstylist, because now you have several apps that are also dedicated towards hairstylists. I call them Uber for hair is what I call it. If you've heard of BeGlammed, the Glam app, Priv, these are some of the apps that act just like, let's say, your Uber apps, where people go onto these apps, they request stylists, and you drive to their location and, you know, provide the service. That's considered a gig economy worker. So if you're in that, you know, if you're in that area, or if you're an independent contractor, meaning you are a booth renter at a salon, or if you work for one of these a beauty company where you're doing platform work for them, or any type of work for an independent business, and you go in and you provide a service for that particular business as an independent contractor, you are required to pay estimated taxes, okay? If you are a limited liability company, an LLC, single member LLC, which technically speaking, a single member LLC is equivalent to a sole proprietor for tax purposes. So the IRS, even though you're a single member LLC, the IRS still treats you as a sole proprietor for tax purposes. You're required to pay estimated taxes. If you are a multi-member LLC, which means that if there is more than one of you that owns the business, which means you file your taxes as a partnership, you are also required to pay estimated taxes, you know, as a partner. Now, if you are an S corporation, okay, then you may or may not be required to pay estimated taxes, because as an S corporation, you're required to be on payroll. So even though you are the owner of the business, you are the sole shareholder, or even if there are multiple shareholders of the S corporation, you are not necessarily required to pay estimated taxes, because you are on payroll and you withhold taxes from your paycheck every pay period. Now, if you distribute money to yourself as a shareholder of an S corporation, then yes, you are required to pay estimated taxes. And then finally, a C corporation, of course, even though a C corporation is a standalone business, which means a C corporation pays taxes, you are required to also pay estimated taxes if your salon is set up as a C corporation. Now, you, the individual working for your business, that's a C corporation, you don't have to pay estimated taxes because you're also on payroll. But the corporation, because the corporation pays its own personal taxes, the corporation has to also pay estimated taxes, just like an individual pays estimated taxes. Now, I don't know if you guys have heard of the saying where people say that corporations are people too. Well, that's where that comes into play. So technically speaking, they're not saying that corporations are actually human beings. What they're saying is that corporations or C corporations are treated like individuals because they are standalone entities, and therefore they are treated like the same way as an actual person would be treated when it comes to taxation. So just like we as individuals have to pay estimated taxes, a C corporation that's a standalone also has to pay estimated taxes. Okay, so the next area that we'll be covering is calculating your estimated taxes. Okay, so well, actually, I already discussed this. Who's required to pay? Anyone who has a business. So basically, anyone in business that files a tax return, as I said earlier. And then, one other thing, if your self-employment income and your income tax combined is less than $1,000, okay, combined is $1,000 or more, or if you are a corporation and you're making $500 or more, then you are required to pay estimated taxes, okay? So the people, once again, who are required to pay estimated taxes are if you owe $1,000 or more as an individual, or if you owe $500 or more as a corporation, you are required to pay estimated taxes. Okay, who is not required to pay estimated taxes? If you are a W-2 employee, you are not required to pay estimated taxes. Now, if you are a W-2 employee, but you have a side gig, or you have a side business, or you have a side hustle, then you are then required to pay estimated taxes on that side business. But if you are just a W-2 employee with no other type of income, you are not required to pay estimated taxes, okay? Second, if you are an employee of an S corporation, which I mentioned earlier, with $0 in distribution for that particular year. So if you don't intend to distribute money to yourself in a particular year outside of the actual your actual salary, then you are not required to pay estimated taxes. Now, another thing is if you owed less than $1,000 in taxes in the previous year, so this is 2019. If in 2018 you owed less than $1,000 in taxes, then for 2019 you are not required by law to pay estimated taxes. Now, here's how I feel about that. Even though you're not required to pay estimated taxes because you made $1,000 or less in the prior year, I still think that it's good practice to go ahead and estimate your taxes anyway, because if you're making money in 2019 and you're not required to pay estimated taxes because you made less than $1,000 in 2018, what if you made, let's say, $100,000 in 2019? You're still going to owe taxes, right? So now you're going to find yourself in a position where you have to scramble to come up with all of the money that's due in taxes for 2019. And in most cases, people are not able to come up with all the money that they are required to pay. So therefore, they wind up not paying and they wind up owing. And of course, you can set up a payment plan, which is fine, but then you want to make sure that you don't repeat that same mistake in 2020, 2021, and so on and so forth. That way it does not compound, okay? Now, of course, if you did not owe any taxes in previous year, or if you did not file a tax return. So if for some reason in the prior year you did not file a tax return for whatever reason, and you were not required to file a tax return, then that means that in the next year, for example, if in 2018 you weren't required to file a tax return, then that means that in 2019 you do not have to file estimated taxes. Okay, so before I move on to how to actually calculate your estimated taxes, are there any questions about who should and should not be filing and paying estimated taxes? I can't quite see on my end. So Carla, if you can help me out with
Yeah, I'm here. I'm looking. There's not a question posted as of yet.
Okay.
I'm gonna let me see. Wait a minute. Hold on. Nope. They haven't put it in the question. Here's one. Okay. Megan asked, what if you file joint with your spouse?
Okay. So you're asking me, if you file joint with your spouse, are you required to pay estimated taxes? Okay, so that's a really good question. Yes, if you file joint with your spouse, then yeah, when you're trying to determine what your estimated taxes are, then you do have to take into consideration your spouse's income. So if your spouse is a W-2 employee and he is having, or he or she is having their taxes withheld on their paycheck, then more than likely you're not going to find yourself in two. Well, let me back up, because even though your spouse may be having their having taxes withheld, if they claimed too many exemptions, that would mean that they're probably not getting enough withheld. Okay, so whenever you're trying to determine your estimated taxes, you always have to consider both people. So you have to do your calculations and include your spouse's income as well, because that will make a huge difference. And now, especially if you're both business owners, it's even more crucial, because more than likely neither one of you are paying estimated taxes. So you want to have an idea of how much you are going to owe combined at at the end of the year. So yeah, so I hope that answers your question.
Okay, we have another one from Dina, and she asked, when would you not be required to file taxes for the year? Is it based on income about or for the year?
Okay, so the question is, when will you not be required to file taxes for the year? So I think I mentioned that already, but I'm going to go back so we can go back and review the slides. Let's see. Okay, so who is not required to pay estimated taxes? So one is, if you're a W-2 employee, you're not required to pay estimated taxes. If you own an S corporation and you're an employee of your company, you are not required if you don't intend to distribute any money to yourself. Now, if you owed less than $1,000 in taxes in the previous year, so basically we're in 2019 now. This is Dina. So Dina, we're currently in 2019. So if you owed less than $1,000 in 2018, now provided you've done your 2018, wait a minute. Okay, well, we're in 2018 now, so let me use 2018 as an example. Okay, so we're in the 2018 tax filing season, right? So if I'm going to do your taxes right now, I'm doing your 2018 taxes, okay? So if in 2017, right, if you owed less than $1,000, you were not required to make estimated tax payments in 2018. Okay, so right now we're in 2019. So when you file your 2018 taxes, if you owed less than $1,000, that means that in 2019, you are not required to make estimated payments for 2019. Number one. Number two, if you did not owe any tax in 2018, or if you did not have to file a tax return in 2018 for whatever reason, and that's something that you would know whether or not you're required to file or not, then that would mean that for 2019, you are not required to file estimated taxes. So usually only under those two circumstances are you not required to file, because if you are in business, any kind of business, if you're doing any kind of business, whether it's a hobby, whether it's an actual business, whether you are a dog catcher, whether you work from home, in your basement doing hair, whether you work from home on your computer and you never leave your house, as long as you are doing some type of work and getting paid for it, you are required to file estimated taxes unless you meet the two exceptions, which is you owed less than $1,000 in taxes in the prior year, or you owed zero in the prior year, or you did not have to file an actual tax return in the prior year. Does that answer your question, Dina? Oh, you know what? I don't think I answered her question correctly. She asked me, when would you not be required to file taxes for the year? Okay, sorry. Let me back that up. Okay, so you're not required to file taxes if you made, well, the tax law has changed. Okay, so now it would be $12,000. So there's something that's called the standard deduction, which is $12,000 for 2018. If you are a W-2 employee, let me repeat, if you are a W-2 employee, okay, and you didn't make over $12,000 in 2018, then technically speaking, you are not required to file a tax return, okay? Us as business owners, if you are a booth renter, if you are an independent contractor, if you work for yourself, you are required to file a tax return. You are not required to file a tax return if you made less than $400. So as business owners, as independent contractors, if we make more than $400, we are required to file a tax return. If you are a W-2 employee and you make you make more than $12,000 for 2018, you are required to file. If you make less than $12,000, you are not required to file. Now, if you are a W-2 employee and you made less than $12,000, however, they withheld income tax from your paycheck, but you made less than 12,000, then you would need to file only to claim that money back. Because you were not supposed to file to begin with, because you only made $12,000, that means that if they withheld any taxes from you, they shouldn't have withheld it. So you will file to get that money back. Okay? Dina, does it answer your question? Or just let me know if I answered your question.
She says, okay, yeah, that answers my question. Thank you.
Okay, great. Okay, so the next topic we're going to be talking about is calculating your estimated taxes. So let me...
Hold on just one sec. I think Kai just put something in. She said, as an S Corp, what percentage are you required to claim as payroll, which I assume is estimated taxes?
Okay, so as an S corporation, okay, the way the S corporation is set up is you're an S corp, which means that you, as an S corporation owner, you have to be on payroll. So you're a W-2 employee of your business, and whoever works at your salon is also a W-2 employee of your business. When it comes to withholding taxes for payroll purposes, all of that is calculated by the payroll company. So you don't have to worry about that. That's not something you need to worry yourself about at all. That's something that is completely taken care of by the payroll company. Okay? So when it comes to paying payroll taxes or estimated taxes, when it comes to employees, it's called withholding. So you, the business, S corporation, what you do is you are withholding taxes from every paycheck of every employee. That's what's called withholding tax for W-2 workers, which is the exact same thing as estimated taxes. So where an employee gets taxes withheld from their paycheck, okay, they get income tax withheld from their paycheck. They get Medicaid taxes withheld, and they also get Social Security withheld, and also state taxes. So there are 4 kinds of taxes that are withheld from a paycheck. It is your state tax, if your state has a state tax. It is your federal income tax. It is your Social Security tax, and it is your Medicaid tax. All of that gets withheld from your paycheck. Now, in terms of the percentage, your income tax for state and your income tax for the federal, that just depends on each individual person, okay? That could change from person to person. When it comes to your Social Security and it comes to your Medicaid, then usually from your paycheck, they withhold about 7.65% from your paycheck. And then your employer, which is the S corporation itself, pays the other 7.65% as payroll expense. When it comes to individuals, independent contractors, business owners, we also have the same types of withholdings, except we call it estimated taxes. So we are paying estimated taxes. A paycheck, an employee is getting taxes withheld from their paycheck. Exact same thing. Now, for estimated taxes, we are paying 4 types of taxes as well. We're estimating taxes and we're sending it to the state. We're estimating our federal income tax and we're sending it to the IRS. We are also estimating something that's called self-employment tax. Self-employment tax is the exact same thing as the Medicaid and the Social Security tax that is withheld from a paycheck. We call it, as business owners, we are paying our self-employment tax, okay? So the self-employment tax that we pay is 15.3% of our net income, okay? So we are paying self-employment tax at 15.3%. A W-2 employee is paying Social Security and Medicaid, which is the same thing as self-employment tax. They're paying it at 7.65%, and then the S corporation is making up the difference. So it totals to 15.3% at the end of the day. That's how that works. And in terms of income tax, as business owners, same thing with a regular employee. What you pay for income tax totally depends on your tax situation. It's different for everyone, and we normally use the tax rate to determine what our percentage is. And I'm going to show you that today, because we're going to do a live demonstration today, and I'm going to show you everything that I'm talking about as it relates to your self-employment tax and how to find your tax rate. So we're going to talk about that later on today. Does that answer your question? I'm not sure who asked that question, but hopefully I answered your question.
Yeah. Kai said, thank you. It did answer her question.
Okay, great. I know I'm a little bit long-winded sometimes, but I try to explain it as clearly as possible, because I know sometimes it can get a little bit complicated. Okay, so the next subject is how to calculate your estimated taxes. So there are a few ways in which we can calculate our estimated taxes. Okay, one is based on prior year. So you can base your estimate on your prior year's taxes, even if you were not in business at that time. So what this is saying is, let's say you were a W-2 employee working for a salon, and then you decided, so let's say in 2018, you were a W-2 employee working for a hair salon. Excuse me. In 2019, you decided that you wanted to start your own business. So you either decided to go booth rent somewhere, you decided to open up a salon suite, or you decided to open up your own hair salon. Well, under those circumstances, you don't really have any history when it comes to paying self-employment tax because you've never been self-employed. So what this is saying is, even though you did not pay taxes as a business owner in the prior year, you can use whatever you pay, whatever your taxes was in the prior year as a W-2 employee. You can use that information to pay your estimated taxes for 2019. So what you would do is you would say, let's say in 2018, your taxes came to, let's say $3,000, or let's just say $2,000. That's how much you owed in 2018. You can simply take that information, divide it by 4, and send the IRS $500 every quarter, and you're good to go. Okay, so you just send them 4 equal installments. Now, this is the way you would do it if you decide that you don't want to go through the hassle of calculating your estimated taxes. Now, the only thing with this is, and it also works for independent contractors who are working, whose situation did not change a whole lot. Or if you make money on it, and your finances or your income doesn't really vary a whole lot. Okay, so it's pretty consistent year after year. So every year, let's say you make $50,000, but the year before that you made $48,000. This year you're going to make $51,000. So you're pretty much in that same financial bucket. So for people like that, this is probably the best way to do it, because you don't have to worry about the hassle of calculating it and recalculating, because every quarter or every month or however you do it, you don't have to worry about that. You just say, you know what, I don't want to have to worry about it. I don't want to have to pay anyone to calculate my taxes. I don't want to have to do it myself. I'm going to just take the information from last year, take those taxes, divide it by 4, and send the IRS equal payments. So that's one way to calculate your estimated taxes. Okay. Now, even another thing is, even if you do decide to do it that way, here are a couple other options. So let's say your last year's income, if your last year's income was less than $150,000 or $75,000 if you file a tax return married filing separate, then here's what you have to pay the IRS. You have to pay them 90% of your current year taxes or 100% of last year's taxes. So what does this mean? Okay, this means that in 2018, I made $80,000, which is less than $150,000, or I made $70,000, which is less than $75,000 if I'm married filing separate. Okay, so under those circumstances, all I have to pay is 90% of my current year's taxes. So if I calculate my current year's taxes and I owe $1,000, okay, I owe $1,000, and I say, wow, you know what? I don't really have $1,000 to pay the IRS. I'm going to just send them $900. That's fine. You would not receive a penalty for underpayment of estimated taxes because you paid 90% of your current year's taxes. So as long as 90% of your current year taxes has been paid into the IRS by the end of the year, you don't have to worry about paying any penalties. Or you can pay 100% of last year's taxes, which means if you calculate your estimated taxes for 2019 and you're starting to realize that, wow, I'm going to owe a whole lot more than I owed last year. If I pay last year's taxes at 100%, if I pay in as estimated taxes what I had to pay last year at 100%, I will be better off because I'll be paying less in estimated taxes than if I paid 90% of this year's taxes, because my income for 2019 is so much higher than it was in 18. So yes, you can go ahead and pay 100% of your last year's taxes. Once again, you take the total, divide it by 4, and mail it to the IRS. You don't have to worry about being charged a penalty and interest for underpayment, okay? Now, if last year's income was more than $150,000 or more than $75,000 if you're married filing separate, then your option is to either pay 90% of your current year's taxes, so that's 90% of 2019's taxes, or 110% of last year's taxes. So where in this instance, where your income is less than 150, you're only paying 100% of last year's taxes. If your income is more than 150, you have to pay 110% of last year's taxes. So keep that in mind. If you do decide to go with the dividing last year's taxes into 4 payments and mailing to the IRS, you have to take into consideration these 2 caveats, okay? Let's see. All right, so another way to calculate your estimated taxes is to hire an accountant. Simple enough. You just pay someone to do it for you. Now, this option is, in my opinion, necessary if your income fluctuates quite a bit. If it fluctuates quite a bit, or if you are dealing with some complicated issues, or if you're married filing jointly and you want to include your spouse's income, and let's say your spouse is a W-2. If your spouse is a W-2, there shouldn't be too much of a problem as long as he's having enough withheld from his paycheck. But if he also has his own business and you have a whole lot going on and your income just fluctuates from month to month, let's say 1 month you make $5,000, the next month you may make 15, the next month you may only make 1,000, and then the following month you may make 50,000. When you have a lot of fluctuation in your income, then it is best to hire an accountant to do it for you. And what we do is we project, okay? So every time we calculate your estimated taxes for every quarter, we are projecting that for the entire year. So let's say, for example, for a quarter, you made $30,000, which means you made, let's say, $10,000 a month for that quarter. Well, I need to project that out for the entire year. So if you made $30,000, that means that what we are saying is we are projecting, okay, that for the year 2019, you are going to make $120,000. That's what the projection is. So therefore, I am going to calculate your estimated taxes based on $120,000. So whatever your estimated taxes is going to be based on that $120,000, and then we'll divide it by whatever we need to divide it by to come up with your estimated taxes for that quarter. Okay, let's say in the next quarter, okay, you made $10,000 because you only made let's say you made $10,000 in the next quarter. So that for the next 3 months you made $10,000. Now what I'm going to have to do is say, okay, now I have to project. Okay, let me see. Hold on, let me pull out my calculator. I know I'm an accountant, but sometimes this stuff doesn't compute. So 30 times 4. Sorry about this, guys. 30 times 4, that's 120. Okay, so let's say, for example, you only made $10,000 for, you only made, let's just say $5,000. You had a really, really, really slow, a very, very slow quarter. And for some reason, you only made $5,000 for that particular quarter. Okay, so if you only made $5,000 for that particular quarter, that means now all of a sudden you are only projected to make $20,000 for the year. So now I have to come back and I have to project. I have to calculate your estimated taxes based on that $20,000. Okay, but I also have to somehow use the 120 that we projected for the first quarter. We're going to take that into consideration when calculating your second quarter. Okay, so we've got to combine the two to come up with your new estimated taxes. Now, because there was such a difference between what you made during the first quarter and what you made during the second quarter, there is a likelihood that for the second quarter, you may not have any estimated tax payments. Okay, so that's basically why you would need to possibly hire an accountant if your income fluctuates a lot, or even if it's just a little bit. If you want to be as accurate as you possibly can be when paying these estimated taxes, if you have fluctuation in income, you may want to hire an accountant, because we have to go in and we have to project in order to come as close as possible to your estimated taxes. Okay, now do it yourself. Do it yourself is required, or not required, but it's best for people whose income fluctuates. And then you're going to use an estimated tax calculator to come up with your income. Now, toward the end of the workshop, I'm going to actually share with you a spreadsheet that I created that will help you do it yourself. If your income fluctuates, this spreadsheet is going to help you calculate your estimated taxes on a quarterly basis. I'm also going to show you how to pay attention to how much, you need to put aside for a month, for every given month. So we'll discuss that toward the end of the webinar. It's going to be a live demonstration, so I can show you how it works, how the calculation works. Me just saying it, I know you hear me, but we are visual people. As you know, hairstylists, we're very visual. We need to be able to see something to make it make sense. So I'll show that to you at the end of the toward the end of the workshop. Okay, so before we move on to quarterly estimated taxes due dates, and before we take a break, are there any questions?
We actually have 2 questions.
Okay.
From Megan and Kai. So Kai asked first, but I just opened up the Q&A section. So I'm going to ask Megan's first, and then we'll shoot over to Kai's question in the chat. So Megan asked, when calculating earnings per quarter, do you take out expenses on products, things like booth rent and supplies, before figuring estimated tax amount?
Okay, so that's a really, really good question, Megan, and that's something that we're going to discuss when I demonstrate to you using the spreadsheet how this works. The answer to your question is yes. Estimated taxes are calculated based on your net income. So if your gross income for the quarter is $30,000, but your expenses for that quarter is $20,000, expenses meaning everything that you paid, to keep your business running, your net income is $10,000. So your estimated taxes are based on the net income of the $10,000.
Okay, let's see. Let me get to Kai here. And Kai's question is, are my payments a write-off if I have an accountant? What exactly does a write-off mean?
Are your payments a write-off? So are you asking me if your estimated taxes are a write-off, or what you pay your accountant to calculate your estimated taxes? Is that a write-off? So are your estimated taxes a write-off? No, they're not. That's not an expense. The only expense that you have, if you are an S corporation, okay, and your payroll, whatever you pay in payroll taxes, whatever you pay in wages, all of that is an expense to your corporation. As sole proprietors or as independent contractors, what we pay in taxes is not a write-off to us. It's not an expense to us. If you pay an accountant to calculate your estimated taxes for you, of course, that is a write-off. Yes, because that's an expense to you. Let me rephrase that. Let me take that back. A percentage of it is a write-off, because really, as business owners, let's say, for example, you are an independent contractor, an S or a sole proprietor. You have to file your taxes, okay? So we file our taxes on our personal return, which is our 1040. But then we have something called a Schedule C, and that is where we show our income and our expenses, okay? Now, keeping in mind that when we're paying, because we have our own business, the money that's coming in is, that's what we use to pay our bills, of course. So we have to, what I usually do is, I would say, anything that benefits you and your business, I will probably deduct 50% of it. So if I were doing your taxes and you paid me to calculate your estimated taxes, if you paid me to prepare your tax return, and then I charge you $400 for that, I will probably write off half of that. $200 will be a write-off, will be an expense. The other $200 will not be, because keeping in mind that I am preparing your personal return as well. And personal expenses are not write-offs. So only half of that would be a write-off. Now, half is not a hard and fast number. That's just what I use. I use half. You may have an accountant use less than half. Some may use more than half, whatever reason. But I normally just say, well, let's just split it down the middle, half and half. Now, if you are an S corporation or if you are a C corporation and you are calculating, or rather, if you're an S, well, I'm sorry, yes, if you're an S corporation and you're paying me to prepare your S corporation tax return, of course, that's 100% right off to the business. Okay. If you are a C corporation and I have to calculate your estimated taxes for you for the C corporation, then yes, it's 100% write off to the corporation. Partnerships don't pay tax either. So usually the partners are the ones that are paying estimated taxes on their income. And once again, under those circumstances, a part of it will be a write off and the other part won't be. I hope that answers your question, Megan.
And then Dina has a very good compliment for you. She says, yes. She says, you are very thorough. It sounds much easier the way you break it down. I've been intimidated when it comes to taxes or tax time.
Well, thank you very much. I appreciate that. And I really do try to break it down as just break it down as much as I can, because I know it can get complicated. And sometimes me as an accountant, when I hear other accountants talking or explaining things, I get confused because I'm thinking, okay, wait a minute, slow down, break it down a little better. So I try to make sure that when I'm explaining something, I know I get long-winded, but I try to really break it down to make it make sense. So I appreciate the compliments, and I'm glad that it's working.
And I think for questions, that's all we have right now.
Okay, so let's see. I'm contemplating taking a break. No, I'm going to go ahead and go into the next segment, and then we'll take a break. So the next segment is quarterly estimated tax due dates. Okay. Now, this is where I mentioned to you guys that even though these are called quarterly estimated tax payments, the way that it's broken down, the way that we mail the payments, we don't really mail the payments we don't really use true quarters to make our payments, and I'll show you why. Okay, so payment number 1 is due April 15th of whatever year you're in. So usually April 15th, you're being slapped in the face twice on both sides of your cheeks. 1, you're having to pay your estimated taxes, and 2, you're having to pay whatever tax you have for that year, because April 15th, as we all know, is tax day. So that means that for 2018, whatever our taxes are for 2018 is due April 15th of the year that we're in, or it could be April 16th or 17th, depending upon when the 15th falls. If the 15th falls on a Saturday, then of course it won't be due until that Monday, which would be the 17th. Okay, so we're having to pay both estimated taxes, and we're also having to pay whatever is due. So that you really have to be organized and, pretty disciplined to make sure you have both monies together. Well, no, then again, if you're paying your estimated taxes, okay, if you're paying your estimated taxes throughout the year, you will never have a problem, because by the time April 15th rolls around and you're paying your estimated taxes for the current year we're in, you already paid your estimated taxes for 2018, which means nothing should be due on April 15th for 2018 taxes. That's how it's supposed to work. However, we know better. We know that it doesn't always work that way. We know that people don't pay their estimated taxes. We know that we may not pay enough in. So under those circumstances, yes, you are required to pay not only what is due for 2018's tax return, but also you're now having to pay estimated taxes for the year that we're in. Okay, so for the first payment, we're paying January, February, and March payments. Okay, so whatever we made in January, February, and March, whatever our net income is for those 3 months, the estimated tax payments are due April 15th of the year that we are in. Okay, let's go to quarter two, second quarter. The second quarter payment is due on June 15th. However, only 2 months are included in that payment, and that is April and May. So where in quarter one, it was 3 payments of January, February, and March. For second quarter, it's only April and May that is due. I know it doesn't make much sense, and sometimes even I get confused. Sometimes I have to go back and look at my calendar to say, okay, what month am I calculating for this payment again? I do it all the time. In fact, as I was creating this class, I had to go back to make sure that I got my fourth quarter correct. I was like, that doesn't make any sense. But I do it every time. I do it every single time. I have to go back just to make sure I'm not making a mistake, because it doesn't make much sense, okay? So for the third quarter, it's due September 15th of the month. Now this one includes 3 months. So it's June, July, and August. So when we make our September 15th payment, we are including everything that we made in June, everything we made in July, and everything we made in August, okay? So far, okay, that makes sense. Quarterly makes sense. Now, we get down to the fourth quarter payment, which is not due until January 15th of the following year. So we are currently in 2019. So our fourth quarter payment is not going to be due until January 15th, 2020. Now, for the fourth quarter, it includes 4 months. It includes September, October, November, and December. This is where I get confused sometimes. I always have to go back and make sure that, okay, let me make sure that I have this right. So 4 months, September, October, November, December, is due January 15th. And yes, that is the case. It hasn't changed, it doesn't change, but I just keep forgetting for some reason because it doesn't make sense. Because when I'm thinking quarterly, I'm thinking January, February, March, April, May, June, July, August, September, October, November, December. That's what makes sense to me when I'm thinking quarterly payments, right? But no, the IRS just has to make it just a little bit more complicated, like they do everything. You know, you have to add a little something to it to throw us off. And that's pretty much what they did here. So keep in mind, for your first quarter payments, it's going to be due April 15th. So that's next month. So by next month, you should be thinking about paying your first quarter for 2019. Because if you don't get your first month's payment in and you're behind with your first month payment, then it just makes everything more difficult. Usually what happens under those circumstances, you're constantly playing catch up and you never catch up. And then you find yourself in April 15th, you know, either not paying your fourth quarter or just saying, you know what, I'll just wait till I file my taxes and worry about it then. So make sure you have your payments ready for the first 3 months on April 15th. Keep in mind, second quarter, we're only dealing with 2 months, okay? And then, of course, for the third quarter, it's normal, June through August, and the third quarter, September through December, is 4 months, and it is due January 15th of the following year, okay? Now, even though it is due January 15th of the following year, if you file your tax return by January 31st of that same year, you do not have to make your estimated taxes for the fourth quarter. So let me repeat that. Under normal circumstances, like for example with me, I had to pay my 2018 quarterly taxes on January 15th of 2019 because I knew that there was no way I was going to file my tax return by January 31st. It wasn't going to happen. It just wasn't. I hate doing my own taxes, and I wait to the last day to do mine. So I already knew, okay, even if I'm not busy, I already know that's not going to happen. So let's not even play around. Let me go ahead and pay my quarterly taxes. So because I knew that I was not going to file my tax return by January 31st, of 2019, I went ahead and made my quarterly estimated tax payments for the fourth quarter of 2018. I went ahead and paid it January 15th. So if you know for a fact that you are going to file your tax returns by January 31st, then you don't have to worry about paying quarterly estimated taxes by January 15th for the fourth quarter of the prior year. Okay? Okay, so are there any questions before we take a break?
Right now, there is nothing coming in, come in unless they're typing.
Okay, so we'll give them a couple of minutes just in case they're typing.
Yes.
I just wanted to make sure I was recording this. I said, oh, wait, am I recording this? But yeah.
Yeah, I have it set up to automatically do it.
I am recording it, so.
Okay. It doesn't look like we have a question yet. So maybe we can make another 30 seconds or so.
Okay, and then we'll take what, 15 minutes?
Whichever, 10 or 15, whatever works for you.
Yeah, let's do 15.
Okay. Yeah. So we'll let you call it when you're ready, since we don't have any questions that have come in yet.
Okay, all right. So, well, if there are no questions, I'm going to go ahead and we'll go ahead and take a break. Okay, let's take a break.
So what time do you want us to come back?
We'll come back let's just come back at 2:30.
Okay, guys, we'll be back at 2:30. We're gonna stay on, of course. I'm just going to keep everything muted. So if there are questions over the break, guys, please feel free to submit them, and then we'll do that when we come right back in, jump in and answer those and move on. Does that work, Desiree? Okay. All righty. All right. We'll see everyone back at 2:30. lady, I'm back.
Hey, I'm here. Okay, so let's go ahead and get started. So there are no questions, no questions. So we're going to go ahead and move on to the next topic, which is how to set aside monthly payments. Now, this is really important. It's not a necessity, but it's a best practice. And the reason why it's really important to set aside monthly payments, and I think I mentioned this earlier, is because of the ease in which it's a lot easier to pay something in portions than it is to pay all at one time. That's the reason why in America we have been conditioned to we are a payment society. Okay. So me personally, I am not a payment person. I believe in paying for things up front. If I can't afford it, I don't buy it. I use my credit cards as charge cards. Only way I'll charge something is if I can pay off at the end of the month. That's just how I operate. One of the reasons why I was able to go to school and be a hairstylist at the same time, after being a hairstylist for almost however many years, I decided to go back to school, okay, and get my degree. And one of the reasons why I was able to do that was because my bills are bare boned. I pay the only bills I have are my absolute necessities, which is my mortgage and utilities. I don't carry any credit card. I mean, I don't carry credit. I have credit cards, but I do not charge and pay over time. I don't have any bills. I have no car note. Haven't had a car note since the early 1990s. And believe it or not, this is 2018. And it was only 3 years ago that I actually graduated to owning a car that was in the 2000s, okay? I currently drive a 2011 Toyota something or another. Prior to my 2011 Toyota, all my cars have been in the 90s up until 3 years ago. And I'm okay with that because I had no car note. I have no car note. So I don't have any car notes. I keep my bills really low. And because I do this, I was able to make the decision to scale back as a stylist and go back to school full time. Because I had no bills, okay? So I believe in paying for what I can afford and not, charging things. Because when you have all this debt, you become a slave to your employer. You become a slave to your clients. You can't tell people no. You do things because you have to. When I needed the money, so I'm going to go ahead and do this. Or you slash your prices to just ridiculous amounts because you're just trying to make money, whatever you have to do to get these bills paid. Okay. So I just personally believe in not accumulating a whole bunch of bills. As I said, we are a payment society in this country. If you notice, whenever there's a commercial on television about something that they're selling, or even when you're speaking to a salesperson, they are so quick to tell us, oh, by the way, we accept payments, because they know the minute they say that, you're going to rethink and say, you know what, maybe I can afford it because because they're accepting payments. Not keeping in mind that you really can't afford it if you had to pay off at one time. And then when you're making these payments, there's interest involved. Okay. So, but as you know, it's easier to make payments than it is to pay for something all at once. Now, I say this to say, use that same concept when you are thinking about making estimated tax payments. Rather than waiting until the end of the quarter, or even worse, the end of the year, to come up with the money to pay your estimated taxes, treat it like a bill. Every quarter, every month, you put aside money to make a payment towards your quarterly payments. So what is the best practice? What I do is I have 2 accounts. I have my business account where all of my business transactions live, and I have a business tax account. So every month when I do my bookkeeping, I determine what my estimated taxes are going to be. I divide it by 3, or by 2, or by 4, depending upon the month, depending upon how many months in that quarter, as we saw earlier when I explained to you how it works. And I put that portion in my tax account. And I do that every single month. And the reason why it's important to separate your business income, your business account from your tax account, so that you don't go in and you start spending. Because if you see the money, even if you say, okay, I have $1,000 that's going to go towards my estimated taxes, but if it's in the same account as the rest of your money, you're going to either spend it because it's there, you're going to accidentally spend it, or you'll just say, you know what, let me just go ahead and spend this and I'll pay myself back next month. And you know that never happens. You don't pay yourself back. So the best thing is just to separate it and put it in a totally different account. Now, what I do is I make sure I put it in an account with the same bank, so I can just do an electronic transfer. So once I've done my bookkeeping for that month, I say, okay, well, here's how much I have to put aside. I take the money immediately and I transfer it to my tax account, and that is where it lives, where it stays until it's time to make the payment. So when it's time to make the payment, I go ahead and I do a direct, I pay in one of the different ways there is to pay your taxes, which we're going to get into in a moment. So that is the best practice. And when we go in and we do the demonstration with a spreadsheet that I created, I'm going to show you how to take your quarterly taxes, divide it into the number of months that we are working with, and so that way you know exactly how much you need to put away for that particular month, okay? So before we move on to the next topic, are there any questions about how to set aside monthly payments for your quarterly taxes? So if there are no questions, I'm going to move on to
the next. Good, no questions so far.
Okay, great. So, all right, so the next topic is going to be the different ways in which you can pay your estimated taxes, okay? So there are several different ways, or I should say several, about 3 different ways in which you can pay your quarterly estimated taxes. One of them is by using something called the 1040 ES, which stands for 1040 estimate, which is a form that is generated by the IRS. And let me see, I'm going to see if I can get online and pull up an actual form. So with this particular form, you just fill it out and you send it to the IRS. And if I can't pull it up, I'm going to go ahead and put a link. I'm going to go ahead and put a link in the chat later on at the end of the workshop, so you can download the form. Okay, so you download the form. It's like it has 4 different coupons. So for every quarter, you're going to send in 1 coupon to the IRS with a check. Now, most people, I know I don't pay anything with check anymore, barely. So that's just an option for people who prefer to mail things in and who prefer to write checks, okay? So that's an option to make the payment. The second option is paying online. Okay, so you pay online by going to www.irs.gov/epay. Now, if you use the epay option, usually the IRS will either do a direct debit, a direct pay, which means that they're going to directly debit your account for the amount, for the total amount. Okay, so that's one option. Or you can pay using a debit card or a credit card. And I think if you use a debit card or credit card, I want to say that you get charged a fee, if I'm not mistaken. If you do a direct debit from your actual account, they do not charge a fee. Now, another reason why it's a good idea to separate your accounts is, let's say, for example, you owe the IRS, okay? And they have access. Now, keeping in mind now, they can find your bank, who you bank with. That's not an option. I mean, that's not an issue. They can find, if they're coming after you to seize your money because you haven't paid your taxes and you owe money, and they decide they want to levy your account, which they will and they can find who you bank with. But I always say, why make it easy for them? Let them go look. If they're looking for it, let them go find it themselves. Okay. So if you decide you want to do a direct pay, which means you want to use your actual account for them to just automatically debit your account, which to me is the easiest way. That's what I do personally. Having a separate account, what it does is they don't have access to your actual money. So let's say if they decide to levy you at any point, they won't just go in and grab it. Now keep it in mind now, if you ever get levied by the IRS, before they go in and grab your money, they will let you know. So don't think that they're going to just do it and you just didn't know about it. You'll know. It won't be a surprise to you unless you have changed your mailing address, because they're going to send letters to your home. And they're going to send, and before they levy your account, you must have received at least 4 or 5 letters leading up to the levy. So it's not a surprise, okay? That way you can't come back and say you didn't warn me, because if they don't let you know before they levy your account, you can protest and get your money back. So they make sure that is never an issue. So they make sure they send you all the series of letters that they're required to send before they levy you. So if you have changed your mailing address and you do not receive the letters the IRS send you, then yes, if they levy your account, it will be a shocker to you because you didn't see it coming. But if they have your current address, it's not a shocker to you. You know it's coming, okay? But that being said, if you keep a separate account for your estimated taxes, that's the only account that they at least have access where they can just go in and dip. So that's another reason why it's a good idea to keep a separate account. So it's either that or you pay using a debit or credit card. So when you go to irs.gov/epay, you can make your payment directly there, which to me is a whole lot easier than having to write out a check and attach the coupon and then go to the bank, go to the post office and mail it out. That just seems like a pain in the butt. I don't want to do that. Okay, I want to keep it simple and keep it easy. So I like to pay online. And then your other options, matter of fact, I don't do the online payment. That online payments is what I use for my clients. For the clients that I have that owe the IRS, when I'm doing payments for them, I use the pay online option for them. Now, for my estimated taxes, personally, I use something called the Electronic Federal Tax Payment System, also known as the EFTPS system. This is the best payment method for businesses like us, or if you have a very large payment, if you have an extremely large payment. I think this is the best option. Also, if you are a C corporation, you are required to pay using the EFTPS system. But most of the salons that I work with aren't C corporations, so that's not really an issue. But if you are required to use this option. Now, with the EFTPS option, an enrollment is required, and normally it takes a couple of weeks to get fully enrolled, because you have to go through the process of filling out this form or requesting something. When you request it, you send it to the IRS. They'll send you back a letter with a PIN. Once you get that PIN, you have to go in and set up the account and do a couple of things. So it takes about maybe 2, sometimes 3 weeks. But once it's set up, then that's it. You go to the website, which is the EFTPS website, and that's where you make all of your payments. So these are the 3 ways that you can make payments. Now you can also call. Someone said you can call in and make payments. Now, I've never done that. And so I don't know if that's an option. I'm not really sure. I've never done it. And calling the IRS is like, oh my God. I mean, when I call the IRS, if I'm dealing with a client issue and I have to call the IRS, a lot of times I'm on the phone for an hour, sometimes 2 hours, just waiting for someone to show up. Okay. So I don't like calling the IRS. So to me, that's not really a viable option. I would never use that option unless you don't have a choice. Other than that, I would say go with one of the online options. If not, just go ahead and make the payments using the 1040 ES. Okay. Any questions about that?
I don't see any as of yet.
Okay.
Let's see, I'm just going to double check, making sure I'm not overlooking anything that has come in. Nope, nothing yet. Okay, that means you're doing an awesome job.
Well, it must be. If there are no questions, I must be really, really explaining this stuff so well that you guys are saying, wow, no questions. She really answered it as she's running her mouth. She just answered my question. Okay, so this is still about estimated tax payments. Well, this is about penalties. So we're going to move on to talking about estimated tax payment penalties. So what are penalties? Penalties are basically financial punishment for not doing whatever it is you're supposed to do, okay? So the IRS will penalize you if you don't make either any estimated tax payments or if you underpay your estimated tax payments. Okay, so not making required payments. Not making required payments will cause you to have to pay penalties and interest if you were required to make payments for any given year. So if you're required, so if you don't fall into the two exceptions that we talked about earlier, which alleviates you of the requirement to pay estimated taxes. Remember, if you made less than $1,000 in the prior year, you're not required to pay estimated taxes in the next year. Or if you were not required to even file a tax return to begin with, then you're not required to pay estimated taxes the next year. If you don't fall into that category, then you are required to pay estimated taxes as long as you have any type of income coming in. Whether or not you set it up as a business, whether or not you just said, okay, I'm going to just wake up one morning and I'm going to go online and I'm going to try to figure out how to make money. So I'm going to go ahead and get with a couple of affiliates and I'm going to start marketing their products so they can send me a check. But I haven't set myself up in any way or any form as a business. You are still required to pay estimated taxes because in the eyes of the IRS, whenever you do anything, whenever you sell something, whether it be a service or a product for money, for financial gain, automatically you are a business and you are then by default, you are a sole proprietor because you haven't formally, you have not created a formal business setup. So you're required to pay estimated taxes, okay? Now, another reason why you would receive penalties for estimated taxes is if you underpay. So any underpayment of estimated taxes. Okay, so to avoid underpaying your estimated taxes, you want to do one of two things. And this is sort of reiterating what I discussed earlier. But you want to pay at least 90% of your current year taxes. Remember, we discussed that earlier. Or pay 100% of the amount of taxes you owed last year, whichever is smaller, okay? So if you do this, then when you calculate your taxes for 2019, even if you owe way, way, way more than you even anticipated, you will not be penalized for underpaying your taxes if you paid at least 90% or you paid 100% of last year's taxes, no matter what last year's taxes was. Even if you owed, say for 2019, you wound up owing $30,000 in taxes. But in 2018, you only had to pay $1,000 in taxes because your situation was different. If you pay 100% of that 1,000, you won't get penalized for underpayment, even though now in 2019 you owe 30,000 because you actually went ahead and did one of the two, which is paying 100% of last year's taxes. Now, the exception to the 90%, 100% rule is what we discussed earlier. If you make more than $150,000 per year or more than 75, if you file married filing separate, you are required to pay 110% of the amount the amount of tax you owed last year. Okay. Any questions there before we move on?
I think we have two.
Okay.
Let me just double check. All right. No, actually, again, this is for you, Desiree. It says you're awesome. And second from Dina says you are.
Oh, well, thank you, guys. Thanks.
Yes.
Okay, so the next slide, I'm just going to read this one. Okay, so as entrepreneurs, okay, paying taxes 4 times a year may be a little challenging, but proper preparation, staying organized all year round, and keeping your books tax ready can help make it a painless and achievable task. Yes, because I know it seems unachievable when it comes to paying those estimated taxes. And the main reason is because as business owners, when we calculate how much money we made for the month, okay, we need all that money to pay our bills. Either we need all the money to pay our bills, or we need some of it to pay our bills and the rest of it to pay for our business expenses. And by the time we calculate our business expenses, and by the time we calculate our personal bills, guess what? All the money that we made is gone, and therefore we don't have enough money to pay our estimated taxes. Okay, that's normally how it works. Now, as a W-2 employee, that's never normally an issue because you don't have an option. They take the money from you. They just say, okay, well, before you get this paycheck, we're going to take our portion and give you the rest. So that's never an issue. That means that you are able to, in other words, whatever you get paid on that paycheck, you have to make it work. You have to make it work. You have to make it stretch to pay those bills because you don't have an option. That's all you get. Okay. For those of us that don't have that restriction, we have an option. Okay. Because even though we're required to send that payment to IRS, we just don't do it. So it becomes challenging. So you do have to have some type of discipline to make this happen. You have to really say, okay, I'm going to treat this like a bill. Because at the end of the day, if you don't have enough money to pay your bills, you're going to prioritize, okay? You're going to say, well, my mortgage comes first or my rent, because without rent, I have nowhere to live, I have nowhere to work. If I have nowhere to live and nowhere to work, I really can't make any money, so my situation is going to be worse off. So I'm going to pay my mortgage. Then you're going to pay your electricity bill, because you need to be able to see, right? When you're walking around your house, you need to be able to see where the heck you're going. You don't want to trip and fall and crack something. And then if you own a salon, you have to be able to you need electricity to do your client's hair, because without that, you can't do their hair. So then it makes you, it incapacitates you. You can't do anything. So you prioritize. I would say make your quarterly tax payments a priority. Add that to your list of bills, things that you have to pay. Okay, because it is a priority, and the IRS is going to get you coming or going. So either you pay it now or you pay it later, or you pay for it later. Some kind of way, they're going to get it from you. Okay, even after you die, they try to dig their hand right into the grave and take your money. They don't care. It's almost like you could be dead, doesn't matter. Well, how much does she owe us? Let's get it if we can. If we can't, oh well. But if they can, they're going to try to get it from you. So make it a priority, okay? Another thing is, okay, so how do you stay organized? How do you stay organized so you can make sure that your books are ready year round, to make sure that you are ready for tax, for tax season, that you're organized? Well, you have to have some type of accounting system to do that, whether it be QuickBooks Online, whether it be QuickBooks Self-Employed, whether it be an Excel spreadsheet. It can be something as simple as an Excel spreadsheet, as long as you're doing something to organize yourself, because it's really difficult to think when you're disorganized. I mean, think about it. When my desk is cluttered, honestly, I can't really think. It's almost like, okay, I'm doing the work, but I feel like I'm not doing it right. Something is wrong. My mind is just not my mind is not together because my desk is a mess. When I was a hairstylist, I wasn't necessarily the neatest person. I tried to be neat, but I had to make a mental note to be neat and pick up stuff as I go. It was a mental thing because I had a tendency of just putting stuff down and moving on. But if my station was cluttered, it's almost like I didn't feel like I was doing good hair. It's like I couldn't really get the hair to do what I wanted it to do. And I know it's a mental thing, but still, that was the case. When my station was neat, a client sits at my station, I feel as if, okay, everything just flows so much easier. That's the same thing with your books. If you're not organized, okay, you're thinking to yourself, oh my God, okay, how much do I owe? How much did I make? Am I supposed to make payments? I don't even know where to start. Where the heck do I begin? I have no idea where to begin. What do I do? So you want to stay organized. You want to make sure you are tracking your income. No matter, even if you're tracking it with pen and paper, it doesn't even matter. Just track it. Okay. The simplest form would be to use an Excel spreadsheet if you're not ready to go to some type of tracking system like QuickBooks. Excel spreadsheet, simplest form. And then you can graduate from there as you go. Okay. Any questions before I move on to talking about state taxes? Any questions? Oh.
Yep. We have just a few here. Let's start with chat. So let's see. Rosa made a statement. She says, I'm just going to have you do it. My brain hurts. But Dina says you are actually making it seem very simple. It can elevate so much stress and fear of the unknown. I'm looking forward to putting this all into practice. And then that was out of chat. So let me get to the question. And Megan has one for us. So Megan asked, probably already answered, but just want to double check for clarification. Am I required to make quarterly payments if I file married, joint, and have 2 kids, and pay less than $1,000 as a joint filer with husband's W-2 covering what we owe, and nothing more than $1,000, or even no money out of our pocket for yearly taxes?
Okay, so if you file jointly and you owe less than $1,000 on your joint tax return, then you are not required to make estimated payments. So it seems as if what your husband's withholdings is covering, well, between your husband's withholdings, your 2 kids that I'm assuming are probably minors, which means you get your husband's withholdings, you also get your child tax credit, and let's see, your child tax credit, and well, back in 2018, of course, you had the exemption for each kid, which we no longer have in 2018. But in 17, you would have had your exemptions for your children. You would have had the child tax credit. You may or may not have had earned income credit. I don't know. It depends on how much money you made. All of that will probably have covered, would have helped to minimize whatever you actually owed in taxes. So that could be one of the reasons why you owed less than $1,000. So under those circumstances, no, you're not required to make estimated tax payments for 2000. And if this was a 2017 tax return, then in 2018, you are not required to make estimated tax payments. Now that we're in 18, once you get your 18 tax return filed, you want to now see and compare that to 2017 because of all the tax law changes. I'm finding that some people are either not getting as much back or they may be owing, and then some people are getting more back. It just depends on what your tax situation is, because now the exemption that we used to have for kids is no longer there. So back in 17, you got about $8,000, a little bit more than $8,000 exemption for your kids, and then for you and your husband, that was another $8,000. So that would have been about $16,000 exemption, including your either standard or itemized deduction. Well, for 2018, with a new tax law, that exemption completely goes away. So the $16,000 you were getting in exemptions has gone away. It's no longer there. Instead, we have a higher standard deduction of $24,000 if you're married filing jointly. And then with the child tax credit, that used to be $1,000 per child is now $2,000 per child. So instead of getting only $2,000 last year for child tax credit, you would get $4,000 in 2018 through 2025. So there are a lot of things that have changed. So you want to compare when you get your 18 tax return. You want to look at that and say, okay, moving forward, at least from now to 2025, that is what your tax return is going to kind of look like if there are no changes in your financial situation. The tax return is going to pretty much look the way that it looks now. And after 2025, of course, if the tax law reverts back to what it was, then that's a story for then. So hope that answers your question.
Megan, does that answer your question? She says it makes sense. Thanks so much. You are amazing. She said, yes, ma'am. Oh my goodness.
Any other questions? I guess no more questions, right? Okay.
No, that was all.
All right, so we're going to talk about how to account for your state estimated taxes. Now, this is really short because, all states are so different. So now, as I said earlier, this workshop only covers federal taxes, okay? Now, if your state has income tax, you may also need to set up and pay quarterly state taxes for your state, okay? Now, while the IRS has a universal calculation. So all 50 states, when you're dealing with estimated taxes for the IRS, it's calculated the exact same way for all states. It's across the board. So it's a lot easier to come out with information on how to pay your quarterly taxes for the IRS. When it comes to the state, it's different because each state can implement their own method of calculating quarterly estimated taxes. So I know in the state of Georgia, the IRS, when you're calculating state taxes, it normally starts with your adjusted gross income on your federal tax return, and then all of the exemptions for the state and the standard deduction for the state, and then usually there's a percentage. I know in Atlanta, for Georgia, it's been 6% forever. I do believe it changed in 2018 to 5.75% is the most, and then it fluctuates from there depending upon what your taxable income is. Now that's for the state of Georgia. When I look at other states, because I do tax returns for people in other states, and when I look at the way that their state calculates it, it's somewhat similar to Georgia, but then there are also differences because every state they may have different credits that will further reduce your quarterly, your payments. But it's so different for every state. So I don't really like getting into, states because it is so different. Even though on the spreadsheet that I created, there's an area there for state calculations. And it's just a very basic calculation because I say at the worst case scenario, this is just an estimate. So it's never going to be exact. It's an estimate. So it's always best to pay something in than to pay nothing in. Because if you're underestimating, at least you've paid in something. So that way, whatever you have to pay to cover the shortage is not going to be as much as paying nothing. And if you pay in too much, you get a refund. So either way, you're on top if you're paying your estimated taxes. Okay, so now we're going to go into our demonstration using an Excel spreadsheet to calculate your estimated taxes. So I'm going to attempt to switch screens and see how successful I am. Okay, so I'm going to stop sharing. And then I'm going to try and share my Excel spreadsheet. Let's see if I can pull that off. Let's see.
We do see it.
You see the spreadsheet?
Yes, ma'am.
That's funny because I can't see it. Okay, here it is. I think.
Okay.
Do you see it?
Yes, we see it.
So for some reason it says your screen sharing is paused.
Did you hit pause? I don't have control.
I don't think so. Oh, it says resume sharing. Okay, there you go.
Yep.
Okay, so you do see it. Okay, all right. Let me.
I see it.
Let me make sure this thing is still recording. Okay, yeah. Okay, so let us start talking about this lovely spreadsheet. It took me some weeks to get to prepare. Let's see. Let me grab my. All right. Okay, so this is the Excel spreadsheet that I put together to try to help you guys calculate your estimated taxes. Now, if you have a bunch of W-2 income, if you're filing jointly with your spouse, I did not take any of that into consideration when I created this spreadsheet. I wanted to keep it simple. Now, I could have done that, but if I had done that, it would have taken me a lot longer to create the spreadsheet. And that's just a lot, it's a lot to do. And I just, decided that I didn't want to necessarily go that deep with it for right now. So this is the instruction page. The instruction page tells you how to use the template. We have a chart of accounts tab, which I'll explain to you what that is. We have a transactions tab. We have the income statement tab, and then we have the quarterly tabs, quarter 1 through 4. Now, the chart of accounts tab, basically chart of accounts is just a list of accounts that you use in your business. The advertising, office, accounting fees, insurance, equipment, legal fees, interest, so on and so forth. And then we have some custom fields in here where you can just add in whatever type of expense may not be already, that I didn't already create up here. I was actually thinking about adding some actual expenses that are relative or relevant to our industry. Because I have another spreadsheet that I created where a lot of the chart of accounts are specific to our industry. And I think I'm going to go in and make some changes and do that. That way you can see the types of things that you can actually deduct. So if I do that, you're not having to sit up here and think, oh, okay, well, what do I need to deduct? You can just look in the chart of accounts and say, oh, you know what? Yeah, I think, okay, I didn't realize I could deduct that. I'm going to go ahead and add that to my income statement. So I think I'm going to do that. I'm going to go ahead and make a couple of changes here to make it easier for you guys, where you don't have to go in and start thinking and wondering, okay, well, what can I deduct? So yes, I'm going to do that. So this is the chart of accounts. So basically the category name is the type of expense it is. Basically, that's what it is. What kind of expense is it? And also I have sales revenue, service revenue, sales revenue, other income, and then refunds and returns. That's part of the chart of accounts. Then we have the category. What is it? All of these are expenses, and we have the cost of goods sold, which I need to change that. Cost of goods sold, and then we have our revenue. Now the refunds, I don't know why I put revenue here, but I did. I could change that. Maybe not, doesn't really matter. The reason why I put revenue is because usually when it's a refund, it's something that you are, let's see, other income, refunds. Yes, something that you are getting back. So you may have returned something and it's coming back, whether it's a product or whatever. But anyway, the fact that it says revenue here, no big deal. It doesn't matter. It's not going to affect the income statement regardless. Okay. And then the type of transaction that belongs in this category. So what I did was I included the types of transactions that are related to the category name. So for example, we have advertising or marketing. That's advertising and marketing costs, pretty simple. We have, other expenses. Okay. Now, other expenses and miscellaneous expenses are expenses that I don't really, especially miscellaneous. I try to really avoid miscellaneous expenses. And I tell my clients to please try not to use miscellaneous expenses because it's an IRS audit red flag. When they see a whole bunch of stuff under miscellaneous expenses, it's a red flag because they don't know what's in there. It's a hodgepodge of all kinds of stuff. And the first thing that comes to, I know when I was an auditor for the state, whenever I saw miscellaneous expense, the first thing that comes to my head is what's in there? Are they hiding transactions that should not be expensed? Are they hiding it in miscellaneous expense? So I will ask for a breakdown. I will send the taxpayer an information request telling them to break down miscellaneous expenses. I need to see what's in there. So as an accountant, on the other side of things, I try to avoid miscellaneous expenses. Now, for other expenses, that's okay. And as you can see, under the type of transaction that belong here, I said expenses that don't fit into any other category, but is a common expense. So it may not fit into anything else, but it's pretty common expense. And one thing you don't want to do is to create a list of charts of accounts of 1 million different categories, because it can get really confusing really quickly. And then your financial statements or your income statements just becomes way too long and out of control. So usually when you have an expense that is a common expense but doesn't fit into anything else, you can just throw it into other. But you also want to notate it on and I'll show you where to notate it on the transaction sheet as to what it is. So that way, when you come back to review it, you know exactly what other expenses is. Miscellaneous, I said, only to be used for very uncommon business expenses. So a miscellaneous expense is an expense that is not a common expense for your business. It just so happened, for some reason, it was a one-off for that particular month. Or it's a one-off expense that you don't really intend to have that expense again, or that expense may only come up once or twice a year, maybe 3 times. So it's not common. It's just something that, you know what, I'll just throw it here because it's just so uncommon. That's when you use miscellaneous expense, okay? And then, so that's chart of accounts. Then I have the transaction tab. Now the transaction tab is where you would actually input all of your transactions. Now, when you go in here and you do other expenses, let me zero these out. Let me zero these out. Okay. What was I saying? Gosh, I lost my train of thought. So if you're going to choose other expenses, so of course you can choose that under the categories. So under, you can do the drop down, other expense. So let's find that here somewhere. Okay, other expense. And usually the category type will autofill. Sometimes it autofills, sometimes it doesn't. Don't really know why that is. And I wasn't trying to figure it out. So then I'll just type in, I guess it autofills when I typed in the E, but sometimes when you type in other expenses and you tab over, it would automatically autofill. Okay. And then you would include the date and then the description of what the other expense is. That way, when you go back to try to look and see, what I spent the other expenses on. If your accountant asks you, if you ever get audited and you have to pull this up, you see, okay, well, other expense was whatever it was, because you actually included the description there, okay? So this is where all of your inputting will go. And I say that because let's move over here to the income statement really quick. This is the income statement itself. I have locked this for direct entry because I know that if I didn't lock it, somebody's going to accidentally get rid of a formula. And this is all formula based. So if you try to input anything in here, okay, well, that wasn't supposed to happen. Oh yeah, that happens here. You're going to get a sign that says the cell you're trying to use is protected. Okay, so you can't input anything. The only place you can input something would be under the growth rate, which I'm going to talk about in a moment. Okay, let's see. So before I start inputting actual data, let me go here first so I can tell you. Okay, so we're on 2019 right now. This particular spreadsheet is going to go back and forward. I've created it where you can go all the way back to 2015 to put in prior years. So let's say you haven't filed a tax return in forever and you need to go back a couple of years and you need to gather all of your information. You can actually go back to 2015 and start inputting information. And then it goes all the way through 2024. All the way through 2024. Okay, so let's go back to transactions. So right now, we want to include information for 2019. So we're going to go ahead and do so we'll say service income, we'll say $5,000. Service revenue for the month of February, we'll say $3,000. And then service revenue for the month of March, we'll just say $4,000, okay? Office expense. Now, when you're inputting information on the transaction screen, if it's an expense, you must use a negative number. You have to use a negative number. Otherwise, your income statement is going to be incorrect, okay? So for office expense, it's $500. Repair and maintenance, we'll just say 100. And cost of goods sold, we'll just say $50. And that is for this one, we'll say 100. And then other expense, I'm going to include other expense for 2018. So here's what I'm going to do. So remember this, 2018. Okay, so we'll do $100, and then I'm going to do an income for that as well. So service revenue. Let's do service revenue. For 2018 as well. I can't see anything. Here you go. So 5,000. Okay, so you can see we have everything for 2019, and then we have an expense and also an income for 2018. Now let's go, and then you can type in the description if you want to. If you don't want to, you don't have to. But I always advise my clients to always type in a description because you always want to know what you purchased. So office expense, you want to know, well, what did I buy? You can either type in Office Depot or Office Home, whatever, Staples, or you can type in the exact thing that you purchased. So that way you can come back and you can sort of break things down, okay? Now we've inputted our transactions on the transaction screen. Now let's move over to the income statement. And I don't know why, okay. Now, as you can see, right, you don't see anything. Okay, let's go back to transactions. This is all 2019. We're back to the income statement and you don't see anything. You're saying to yourself, oh my God, where is all my data? That's because we are at 2024. So we got to click here and click on 2019 so we can see all of our data. So we have to make sure we're on the right year. Now let's go to 2018, and you're going to see the two transactions we entered for 18. What is this? It's 2000 and service. So let's go back here. Okay, so we have other. So I'm going to go ahead and click on this. So you can see, because I was just wondering what happened. Why did I see all that data for 18 when I only put in 2 transactions? And the reason is because if you click, because I have prior information or prior transactions that I had put in for 2018. However, I removed it from the screen because I only wanted to see my 2019 stuff. Because let's assume we have data for 2017, 18, and 19. Well, we don't want to see all that. We don't want to look at all that. We want to just focus on 2019. So I went ahead and I removed from view 2018 data and clicked OK. So now we're only seeing 19. Now, when I went to the screen and I realized that, okay, well, I still have stuff from 18. What happened? Well, I went back to the transaction screen and realized that the reason why I wasn't seeing it on the transaction screen is because I had removed it from view. When I add it to view, now you can see all of 18 and all of 19's transactions, okay? Now let's go back to the income statement. So now we're looking at 2018 stuff, transactions, but we don't want to look at that. We want to look at 19. We want to stay in the moment. So we're going to go back to 2019. This is our data for 2019, okay? Now, another thing that I've created with this spreadsheet is the growth rate. So with the growth rate, let's say you made, let's just say $12,000 for the year or year to date. And you say to yourself, you know what? If I had a 30% growth next year, how does that translate to income? So you want to project, if I have a 30% growth next year, what does that mean in dollars? How much more money would I make if I increased my growth by 30%? You just type in 30, and then you see it right here where it says projected. You'll see that in order for you to make if you had a 30% growth, rather than making $12,000, you're going to make $15,600. And this growth rate is available for income and also for expenses, okay? So this is how the income statement works. And I think somebody was asking the question about what you're normally taxed on, or rather, what you're taxed on, estimate how you calculate your estimated taxes. So the estimated taxes are going to be calculated based on the total profit, which transfers to these quarter screens, which I'll show you in a minute. So this is the total income. The expense is $500, and you're left with $4,500. Okay, so that is how the transactions and the income statement work together. In other words, no direct entries here. Everything starts on the transaction screen, and you can get rid of. So if I uncheck 19, I uncheck 18 and click OK, everything goes away. So you are able to categorize or to look at only the items that you want to look at, only the years that you want to look at. So in this case, we're sticking with 19. That's okay. And then we go back to the income statement to make sure it's on 19, and here we are. All right, now, once you have okay, so we have January, we have February, and we have March, okay? This is the first quarter. So the way that I created this worksheet, this information for the first quarter is going to flow to the first quarter tab. So this is what your net income is expected. So based upon the income that you made for the first quarter, which is $12,000, okay, you are projecting to make $45,000 for the entire year. But let me, I'm going to change these numbers because I want to use the numbers that I have, because I had some numbers that I already calculated. That way I can run through this a lot quicker rather than trying to figure out too much, and it'll be a lot smoother transition. So I'm going to change some of these dollar amounts. So let me see something. Let's do this. Excuse me for 1 second, guys, while I divided by 3. Okay, so let me go back in here. I'm going to get rid of this. This is just for ease of explanation. Okay, well, that's not what I was trying to do. Well, see what I tried to do? I just tried to input a dollar amount, and it warned me because I just kind of forgot that I couldn't do it that way. So even me that created this worksheet was about to really screw up royally. So I need to go back here and make my changes. Let's see, well, let's just do this. Okay, so all right, so for the first quarter, we made $15,000. When you click on quarter one, you'll see $60,000. So this is what you are projected to make in 2018. So with this particular cell, I've already done all the calculations and I've done your total projection. So your projection for 2019 is going to be 60,000. So your self-employment net income, okay, this is what your self-employment net income is. Now, the reason why knowing your self-employment net income is important is because this is the dollar amount that is going to be used to calculate your self-employment, your self-employment estimated taxes. Okay, keep in mind your self-employment estimated taxes is totally different than your actual income tax. Okay, it's different from your income tax. Let me get rid of this. Okay, so it's different from your income tax. So based upon your self-employment income, for 2019, okay, your self-employment tax is $8,478. Okay, that doesn't change. That is your self-employment tax for the year. Now, in order for you to calculate your estimated taxes, there are a couple of things that you need to do. And this is what I'm doing right now is just a really simple run through, because I'm going to create an actual class that's going to come along with the spreadsheet that is going to explain to you how to calculate your taxes in a more in-depth and detailed way. So that way you are not confused. Right now, don't worry about trying to figure out how to do this, because in the class, I'm going to break it down so you can truly do it yourself and understand everything that you need to do and why you need to do what you need to do. So right now, this is just a quick demonstration just to show you what this spreadsheet can do and how it's going to calculate your estimated taxes, okay? So here we are. So we've calculated what our anticipated net income for the entire year is. We've done that. We've calculated what our self-employment tax is going to be. Now, what we have to do now is, in order to reduce what we owe, we're going to include the standard deduction. Remember, in 2018, standard deduction changed. If you are married, if you are married and you file separately, then for 2019, your deduction is $12,200. If you're married filing jointly, it's $24,400. And if you're a head of household, it's $18,350. So we're going to just use a single or the married filing jointly. That you input. Now, all these fields, you cannot input anything in these fields. The only fields you can input in are the fields that are highlighted in whatever color this is, some type of blue or green, okay? So we want to input our standard deduction right here. So that's what you're going to do. You're going to input your standard deduction in this field, okay? Once you input your standard deduction, then you have your taxable income. Now, one other thing that was added for 2018 is something called the qualified business income deduction, which we didn't have in prior years. So in 2018, with the new tax law, if you made $60,000, okay, you get an additional $8,712 deduction in income. So therefore, your taxable income becomes less by $8,712. We didn't have this prior to 2018. So this is really something this is great for business owners, because we get a 20% deduction on our net income. Okay, so I've gone ahead and calculated that for you as well. So now your taxable income would have been $43,500, but with the new deduction, it is now $34,849. This is your taxable income. Okay, so we're got to figure out how much tax you owe. Now remember, when we talked earlier, I said to you that as self-employed people, there are two types of taxes that we pay. We pay our self-employment tax, which is Medicaid and Social Security. That's what you see right here. The $8,400, this is our Medicaid and our Social Security tax. This is not income tax. So now we got to figure out what our income tax is and add that to our tax obligation, and then we'll get our total tax, okay? So in order to add this, we have got to figure out what our tax is, what our tax bracket is. Okay, so now pay attention here, because this is where it can get a little bit confusing. But as I said, I'm going to explain this thing very thoroughly on the video that the class that I create, so that way you can follow me step by step. So in order to figure out what our actual tax bracket is and what we have to pay in income tax, there are a couple of things we're going to have to do. We're going to have to use the 2019 tax rate schedule to figure out what our tax is. Okay, so we figured it out already. Married filing separately is what we're filing. So we're going to scroll down. Let me write down this dollar amount really quick. So the dollar amount that we're trying to figure out a tax on is $34,849. This is our taxable income. So let's scroll down to married filing jointly. Here it is. So how much did we make again? $34,849. So let's find that on the chart. So here it is. If you made between $19,400 to $78,000, your tax rate is 12%. So this is where we need to be, because we only made $34,849. So now how do we calculate what our tax is based on this table? Okay, here it is. So we're going to our tax is going to be, up here, 12,000. It's going to be $1,940 plus 12% of any amount over $19,400. So let's do the calculation. So we already know off the top based upon how much money we made, we are going to at least have to pay $1,940. So here it is right here. Okay. Now we're also going to have to pay any amount that we made over 19,400. We're going to have to pay 12% on that. So remember now, we made 34,849. So let's go ahead and say, let's go 34,849. Okay. And then let's add the 19,400, any amount over that. So now we want to figure out what that is. So we're going to subtract this $9,400 from what we made, which was 34,000. So we're left with 50. Let me put my glasses on because I can't even see. Okay, so we're working with 15,449. So what is 12% of that? Let's see what that is. So we're going to do that multiplied by 12%. Here you go. So 12% of 15,449 is 1,853. Now let's add. We're going to add. I know this looks a little bit messy. We're going to add the 1940. We're going to add that. Uh-oh. Sorry. So we got to add 1940 to that. So what do we have? So our actual tax is going to be $3,798. That's what our tax is. 3,793. So let's add that here. 3,793. So based upon, now keep in mind that you're going to also have credits, and I'll talk about this where you can pull these credits from when I do the class. But you're going to have credits that's going to further reduce. It's going to further reduce your taxes. And not only that, for those of you that pay your own health insurance, if you pay your own health insurance and you qualify to deduct your health insurance, that's going to also further reduce your taxes. So let's assume that you paid. I know for me, every month I pay. Let's see, my total. I pay, I think $640 a month is what I pay in health insurance. So 640 times 12. So that's $7,680. Well, plus my dental. So let's say that's 640 plus 16 times 12. So 782. You can include. You're going to include that here where it says deductible health insurance. So we're going to include it here, 7872. So that, as you can see, has further reduced your, that reduced your, and we're going to have to change how much you pay in tax now because this number is no longer relevant. So this amount that we pay, that we thought we were going to pay in tax, it was only relevant until I included my deductible health insurance. Also, if you paid any type of self-employment, any type of SEP or simple account, and this usually is for retirement accounts, you can also include that here, and I'll show you how to find that during the video. And then all other adjustments, all of that needs to be included here, okay? And then also any credits that you get are going to also be included down here. So now that we have redetermined what our tax is, I don't want to have to go back and recalculate it, but let's just assume that based upon the new numbers, taxable income, our tax has now reduced to $2,500. Let's just make that assumption. Now you can see what your quarterly taxes are going to be for, what your quarterly taxes are going to be for the first quarter, okay? Now your total, now based upon your estimate of what you think you're going to make in 2019, which is $60,000, okay? Your taxes, your total estimated taxes for the year with all of your deductions and your adjustments comes to $10,977. So then your estimated taxes for January, February, and March is $2,744. Now, what I would do under this circumstance is I would divide that number by 3. Okay, so I would say 2,744 divided by 3 is $914. This is what I need to put in my account for the month. Now, this only, okay, we used 3 months. We used 3 months to figure this out, to figure out this Q1 estimated taxes. So under the circumstances, this doesn't apply. But you can do the exact same thing that we just did on a monthly basis. And once again, I will show you and demonstrate how to do that. We can do that on a monthly basis. So that way, every month, you can go to this sheet to figure out what your quarterly is going to be based on that month, and you can divide it by 3, and you can save whatever that amount is in your account until it's time to make those quarterly estimated payments, okay? I know this probably sounded really, really confusing, but trust me, it's not that confusing once it's explained to you in a lot clearer format. Right now, we're just sort of running through it just so you can see what you can do, okay? Now, let's talk about state taxes. So this automatically calculates. So I've created something where it automatically calculates. And what I did with the state, I kept it really simple because, as I mentioned earlier, most states calculate their taxes either differently, or some states don't even have tax. What I did was I started with the adjusted gross income. For Georgia, the standard deduction for each individual, if you are either married filing separate or if you're single, is $3,000, or your exemption is $3,700. Your taxable income, therefore, is $26,000, not including any credits you may get. So therefore, your tax for the year would be $1,500, and I divided that by 4. So your estimated taxes for this particular year, for the first quarter, is $385. Now, it may not be exact, but it's close enough to give you an idea, to at least have you pay something to the state. That way, you're not, at the end of the year, you don't have this huge state tax bill. You can at least say, okay, either they're going to owe me money back, or I'm only going to owe just a little bit because I attempted to pay something. So once again, I'm going to discuss how this works during the video. Now, one other thing before I close up. Let's assume that you don't want to use this, spreadsheet to calculate your estimated, to track your income. All you want to use it for is to figure out what your estimated taxes are. Here's what you can do. So let's go back to the transaction screen, and let's go ahead and zero out all of these. So we've zeroed everything out. So all you need to do, let's say you know what you made for the last 3 months because you have another system that's tracking your income and your expenses, but that particular system is not helping you calculate your quarterly estimated taxes. Then all you need to do is you can use the service revenue. You can use the service revenue option, and then just type in what that total is. So let's say for the last 3 months, you made $40,000, $40,200. Just type in whatever you made for the 3 months. Let's come over here. So now that you've done that, you can see, and you can use any month. In this case, because it's quarterly and you're just typing it in, let's go ahead and use March. Let's use March. We'll use March 31st because that's when the quarter ends, right? So now we're going to go in to income statement. Now you can see the whole number, okay? Now keep in mind, even though we did service revenue, because you pulled this from a different system, all of your expenses have been accounted for. So you may have made $60,000 or whatever you made. And and you made $60,000, and then after expenses, it came to 40,000. So you're only going to type in your net income, only your net income. Don't type in your gross, just type in your net income. When you type that in, now you can go to, before we do that, let me change this. Let me get rid of this. I'll get rid of all of the inputs. Let me get rid of them. Let me go back here. Let me get rid of this really quickly so I can clear out the. All right, so that's all cleared out. So as you can see, when I removed that dollar amount, it cleared everything out. So now let's go back to the income, to the transaction, and let's put in the same amount. Let's put in 12,000. That's fine. Okay, so 12,000. Now we're going to go to the income statement. We can see the 12,000, and then we come back to quarter one, and then once again we can see everything automatically populated. So now you made $12,000 for quarter one, quarter two, and quarter three. You went ahead and you just manually included the $12,000 under service revenue. This is your net. This is the net income for the last 3 quarters, not your gross. This is your net. Now you can go to the income statement and you can see where you inputted that information. Go to quarter one, and you can go ahead and do what we did before. Add your any deductibles you may have, or any adjustments you may have, any credits you may have. You can go into the you can scroll down to figure out what your taxes are going to be. Let's see, you can also include your deduction, whether it be single, married filing separately, married filing jointly, head of household, include that. So you're going to basically go through the same process. You can see where you have your new 20% qualified business income deduction. So it all calculates. So this is an option that you can use if you don't want to use a spreadsheet to track your income and your expenses. Now, of course, quarter one, then you have quarter two, quarter three, quarter four, and I'm not going to get into that right now. I'll get into that later on. I'm going to let you know how everything rolls over. So when we go into quarter two, so when you start inputting income, say for quarter two, everything rolls over. So you have your quarter one information and your quarter two information is going to all roll in to this dollar amount here, and it's going to start the process all over again. So by the time you get to quarter four, okay, by the time you're in quarter four and you see total estimated taxes, that amount should pretty much tell you now it's no longer an estimate. At this point, you're going to know what your taxes are for 2019. Okay, because everything rolled from quarter one, two, three to quarter four, and it gives you the final number here. So what this spreadsheet does, it just simplifies the process of calculating your estimated taxes, where you don't really have to think that hard. Just plug in the numbers, and the formulas will do all of the calculations for you. The only thing that you are going to have to plug in are going to be if there's any kind of other income. Like, for example, I have rental property. So my rental property is going to go under other income. I'm going to type that in. If you got alimony, because as of 2018, with the new tax law, alimony is now taxable to you. Okay? It never used to be. Prior to 2018, it was not taxable, but now with the new tax law, alimony is now taxable income. So if you're receiving alimony, that's where it's going to go. If for some reason you're receiving unemployment, let's say you lost your job and you're receiving unemployment, this is where it's going to go. Okay, so this is going to be a plug if it actually relates to you. Once again, your deductible health insurance is a plug. your self-employment retirement savings is a plug number. And these are plugs because not everybody has them. Not everybody has other income. Not everybody has deductible health insurance. Not everybody's paying on their pension. Now, as you can see, part of the adjusted gross income, we have part of our self-employment. The reason why this is here, and the reason why it's not colored, because this is a calculated field, because everybody gets the benefit of a deductible for their adjusted gross income. Okay, so that's not a plug, that's an automatic calculation. And then this is a plug because it changes for everyone, and that's because either you are going to use standard deduction or you're going to use itemized, whichever is greater. You can look at your tax return from prior year to figure out what you think you need to use, and it's different for everyone, so that's a plug. Taxable income is a plug because it's different for everybody. And all of your credits are also a plug because it's going to be different for everyone. Self-employment is not a plug because it is what it is. We are all paying the exact same amount in self-employment tax depending upon what our net income is. Okay, so that's not a plug. And then the estimated taxes, neither one of these are plugs because these are what they are. For the state estimated taxes, I left these as formulas and plugs, just in case your state does things a little bit differently. You can go in here and make some adjustments to fit how your state actually calculates its state estimated taxes. And then of course we have the different tax rates. Now keep in mind, this is only for 2019 because these tables right here and the standard deduction amounts are going to change for 2020. So while you can still use this spreadsheet, if you so desire, you would have to make sure that you get the correct standard deduction amounts for 2020 when the time comes, and you get the correct a tax rate table for 2020. So these are the only two things that you're going to have to change, unless of course there's some other change in the tax law, and if there is, I'll keep you guys informed. Other than that, this part of it, the estimated tax worksheet part of it, stays the same. Okay, so it's 3:52. I think I did really good time-wise. That's all I have for you today. And if there are any questions, please feel free to ask and I can answer them for you.
Rosa has a question, and her question is, of course, directed to you in terms of services. In order to work with you, do I need to get QuickBooks Self-Employed?
Possibly. Usually I will have you, I'll get your email address and I'll send you a link, and that link is a questionnaire about your business. And then when you answer all of those questions, and I can determine what the best solution for you is, whether it's QuickBooks Self-Employed or whether it's QuickBooks Online. And then QuickBooks Online has 3 options. It has the Simple Start, Essentials, and Plus. So we need to determine which one of those 3 is best for you, or whether QuickBooks Self-Employed is a better fit for you. So if you're interested in that, then you can, I think I can I'll leave my website address in the chat so that you can contact me. And when you do that, I'll have your email address, and then I can go ahead and provide you with the form that I would need you to fill out for me. So here's my website address. Let me write that. Let's see.
Now, Desiree, just so you know, I have also included your information and links in the replay in the portal.
Okay.
So they will be in each section for anyone who needs to get in touch with you. It is the that website as well as your email address and phone number that was listed that you gave last time.
Okay.
So they do have access. You're on the replay platform.
Okay. Okay, sounds great. So I guess I answered that question. Who asked the question?
Oh, Rosa did.
Oh, okay. Can you see me now?
Who, me? Yes, we can see you.
Oh, okay. All right. Any questions? Oh, somebody's asking, where is the replay platform?
Rosa, that was sent to everyone via email 2 weeks ago. It's on Teachery. So if you have access to Teachery, you should be able to see it. Well, you still have to go in and log in for the course. So I sent a detailed email with instructions and a video on how to access it and walk everybody through it. So check your what do you call it? Your spam folder if you didn't see it in your email. But the email actually went out on the 20th. Actually, it went out the 21st, Thursday, the 21st of February. I sent that email out.
All right. So before we wrap up, let's talk about a little bit about what we'll be discussing next week. In 2 weeks. Tracking your income and expenses using QuickBooks Self-Employed or Intuit or QuickBooks Online, or using an Excel spreadsheet, whichever works best for you. We're going to talk about collecting the correct information from your vendors. So these are the things you need to collect from your vendors so that way you have that information for tax time. We'll talk about tracking your miles and what apps you can use to do that. We're going to talk about creating a business budget and also using cash flow worksheets. And I think for the cash flow worksheets, I do have a complimentary worksheet that I'm going to be providing all of you that are on. For those of you that are on the workshop, on this workshop, I'll be providing a cash flow worksheet, and what that's going to do is going to help you manage your cash flows, so that way you can see the money's coming in, money's going out, and also what you have left over each month that flows into the next month to help you with your cash flow, because cash flow and net income are two totally different things. You can actually continue surviving in your business even if you have losses for 6 months. If your net income is in a negative amount for 6 months, you can continue to exist as a business. However, if your cash flow is a negative for 1 month, you're more than likely you will not be able to continue existing in your business. So there is a difference between the cash flow and the net income. We're going to discuss what the differences is, or rather what the differences are, and how to control your cash flow, or at least see what your cash flow is doing with this worksheet that I'll be providing for you. I'll demonstrate it like I did today, and then also you guys will get a complimentary copy of that workflow. The worksheet. So that's what we'll be discussing in 2 weeks from today. And I think I've already asked you if there are any questions. And this is my contact information for any of you that are interested in copying it down. Okay. Carla?
Yep. Okay, is that it? Let me take myself off of, I wanted them to focus on you if they could see you. That's why I turned my camera off. Yeah, so at this time, guys, are there any questions, any last minute questions or comments? It's always great to get your input about the session. Any aha moments, any takeaways that you guys would like to share with us? And definitely, as always, Desiree, this is so powerful. Great. Now, Desiree, did you mention how you were going to get them or their opportunity?
No, I was just about to
gain access.
Just about to mention that. So,
okay.
So for the spreadsheet that I just demonstrated, the normal price for the spreadsheet is $99. But for those of you that are on the platform today, you're going to get it for $49.99. And Carla's going to handle that. I'm going to send the information to Carla, and she's going to reach out to you and provide you with the link to purchase the spreadsheet if you're interested. There are a couple of things that I need to adjust. So it won't be ready for another, I don't know, week or two. So I need to go ahead and change the chart of accounts to make it more relevant to our industry. And then a couple of other things that I'm going to tweak. But for the most part, I have to do some recording. I got to record it. And that's really where the time is going to be. I got to record the actual class, which that's pretty much where the time is going to be, because I don't really want to put that spreadsheet out there without instructions, without a class, because if I do that, you might bumble around trying to figure out how to use it. So I want to try to make sure that you have all the tools that you need to be able to use the spreadsheets in such a way that it's going to benefit you.
Let's see, we have something in chat. Oh, I'm sorry. Well, if I would have just looked over there. I'm so used to with this being down. Okay, amazing class. Thanks again for everything.
You're welcome.
Thank you. Thank you. Yes, Desiree is amazing, like with 3 capital A's. Yes.
Okay.
All right.
So if there are no further, someone has their hand up. Amy Robbins, is that from?
It might be earlier, but just double check. I didn't look at that. Megan says, amazing class. Thanks again for everything. You guys are so very welcome.
You are most welcome. Okay, well, we did really good time because it's 4:01.
Yeah.
I didn't even think that I would last this long, but I always think that, right? But once again,
right. You are definitely killing it. It's been wonderful. So, yeah, I'm excited about it. So again, guys, look forward to some in the next 2 weeks, some additional information from us. I will do a multitude of things, especially with all of the links that Desiree has shared, will definitely be under the resource tab inside of the Teachery course portal where all of the replays will live. So every link that she has given us related to that particular session will be in the course. So you guys, whether you write it down now, just letting you know there's going to be a secondary location for it. So you always have access to the information, and Desiree. And so I just want to thank everyone for being here today. Again, I can't say thank you enough to Desiree for her time and putting this in and putting it together. It has just been phenomenal. And I think this is just the start of something greater.
You're most welcome. And I appreciate you having me and sharing your audience with me. I definitely appreciate that. And I appreciate even more for those of you that stayed from beginning to end. That's, that's not an easy thing to do, especially when we're talking about this kind of stuff that's not exciting. It's exciting to me. I like it, but, I don't know about you guys, but, but yeah, I really appreciate that. It just shows me that you guys are definitely focused and interested in changing the way you do business and understanding your business, which is a wonderful thing. It really is, because that's what keeps people in business, is when you understand actual business behind the business. You can be the best colorist, the best hair cutter, or the best stylist, but if you can't manage your business and manage your money, none of it matters. None of it matters. I've seen people who make 3 figures fail. And it's not because they're not making money. They're making plenty of money. That's not the problem. It's just that they are not able to, they don't pay attention to the business side of things. So, where Carla helps you to really understand how to build your business, once she builds it for you, and you need someone like me to help you, save money, or know what to do with the money, or just stay compliant. Basically, it's to stay compliant, because if you understand what you need to do when it comes to this compliance, even when it comes to creating budgets, creating cash flow statements and all of that, everything that she teaches you will just build upon what I have to share with you, and you're going to be unstoppable. Absolutely unstoppable.
I tell you, the knowledge in and of itself is great, but to be able to apply it and see the results is phenomenal.
Absolutely.
And that's one thing I tell people, knowledge is one thing, but applied knowledge, no one can take that.
Exactly.
That's what moves the needle.
Exactly. Knowledge is power. If you have that knowledge, you can take it. Because take it, and if you apply it, like she said, I mean, you can really, you can do some wonderful things.
Yeah, absolutely. All right, guys, I think with that being said, we are going to call it a day, and I hope to see each and every one of you back on March 18th for our final session of the three-part series, where we're really going into, and Desiree shared the topics and the areas that she is going to cover during that period. And so I just wish you guys a great rest of the day and a wonderful start to an awesome week. And as you know, you can reach out to Desiree. She's giving you her information on anything related to taxes or additional questions you may have, or services that you may want her to now assist you with. So guys, thanks so much. And I will see you if you are in Hairbangers Academy on tonight. This is my night, Money Making Monday, and we're going to be talking about promotions and marketing based off of a continuation of Gary Call's presentation on last week, product knowledge. So we're going to go into actually positioning your product, your marketing, and your retail sales offer. So, all right, with that being said, take care, guys.
All right, guys. Bye.
Bye-bye.